In 1975, Jack Bogle created the first index investment trust with his company, the Vanguard Group. At the time, some of Bogle's competitors and critics described the ideas as un-American, showing their disapproval for such an idea. Why would people ever settle for average returns? Now, index funds are seen as a popular method of investing for millions of people across the globe, being a widely diversified asset type with a low-cost benefit. In this video, we will answer what index funds are and why you may choose to invest in this asset type over an actively managed alternative. The main point being, would you settle for market returns, or do you strive for outperformance? If you like what you see here today, or feel like you've learned something, please drop a like to help with the YouTube algorithm and subscribe if you've not already done so. So, we can start with index numbers. An index number measures the change in select individual data points compared to a base number, which is often represented as 100 or 1000. Let's use the example of a stock market to show how index numbers work. In this example, a market is represented by the number 100. It achieves an 8.3% return in the first year. By the end of the first year, the index number will now be represented as 108.3. If the market receives a 5.5% gain in the second year, the index will now be represented as the number 114.26, and so on. This brings us onto the definition of an index fund. An index fund is a portfolio comprised of different assets, designed to replicate the composition and performance of a given market. The Vanguard FTSE 100 index is comprised of just stocks and aims to mimic the performance of the FTSE 100. These are the largest companies listed on the London Stock Exchange. So why were they created? In the first edition of Burt Malkiel's book, A Random Walk Down Wall Street, Malkiel found that a vast majority of actively managed mutual funds were failing to beat the market averages. And in 1973, he wrote, "What we need is a no-load, minimum management fee mutual fund that simply buys the hundreds of stocks making up the broad stock market averages and does no trading from security to security in an attempt to catch the winners." So clearly there was demand for an index fund prior to Bogle's first in 1975. The first widely accepted index investment trust, later named the Vanguard 500 Index, tracking the S&P 500, initially started with $11 million. But now, the Vanguard Group has a total of over $6.2 trillion in assets under management as of January 2020. So what are the benefits of owning index funds? One benefit is the low-cost alternative to actively investing. By investing in index investment trusts, the individual investor eliminates the transaction cost in investing in individual shares. Many investment platforms charge you per trade. Hargreaves Lansdown charges £11.95 per trade, and AJ Bell can charge £9.95. Index investment trusts do not trade publicly on stock exchanges, so brokerage fees are automatically eliminated. Because there are no transaction costs, index investors can benefit from paying less in capital gains tax. If you own an S&P 500 index investment trust, for example, you only own one asset, rather than owning 500 individual shares of all the companies. This means you will only need to pay capital gains tax once on one position, compared to 500 times for the individual shares. Investors do not need to pay capital gains tax until a position is closed, and wouldn't you rather pay once than 500 times? All this contributes to a higher net return. Another benefit would be that investors can get immediate access to diversification. Buying an index fund allows you to invest in tens, hundreds, or even thousands of assets immediately. If you only own 10 individual companies in an actively managed account, and one of them collapsed to zero, all other things being equal, this would represent a 10% decline in your account value. Compared to holding an index fund, the FTSE 100 for example, where you collectively own 100 companies, if one collapses to zero in the index, this would generate a 1% decline in comparison to a 10% shock. The downside is that, by definition, you cannot beat the index. By investing in index funds, you eliminate the possibility of outperformance or beating the market. When you choose a passive index fund, you will not beat your benchmark, you will simply match it. Let's say you choose to invest in an S&P 500 index fund over the 5-year period from 2015 to 2019. The results show you will earn just over 10% per year on average. But you may feel you are a well-informed, rational investor who has the time to research and select individual stocks for your own portfolio. You decide not to invest in index funds in hope to beat the market. The skill involved in beating the market is called alpha. Over the same 5-year period, let's say you beat the market every year and earn an average of slightly over 12% per year. Your alpha is 2. This would not be achievable by selecting the benchmark index fund, in this case the S&P 500. But what did the professionals say? In 2007, Warren Buffett made a bet that he could beat a basket of hedge funds over a 10-year period by simply investing in an S&P 500 index fund. If Warren Buffett won, his bet would pay out $1 million. The results showed that a passively run index fund would have returned an average of 7.1% per year. The hedge funds, 2.2% per year. To emphasize this, let's say you put $10,000 into an S&P 500 index fund in 2007. Over that same 10-year period, that $10,000 would have accumulated into around $19,856. The basket of hedge funds, on the other hand, would have turned that $10,000 into roughly $12,431, and Warren Buffett won the $1 million prize. So what does Buffett have to say about indexing now? On the 2nd of May 2020, in Berkshire Hathaway's annual shareholder meeting, Buffett states that the best thing to do for most people is to simply own an S&P 500 index fund. Clearly, he still has faith in this strategy for the average investor. Howard Marks of Oaktree Capital says in his book, The Most Important Thing, that indexing epitomizes investing without value added, meaning that passive investors can earn good enough returns without the advanced skills and knowledge of actively investing. However, he does not explicitly say that all investors should choose index fund investing. He does support the idea that investors can try for outperformance through active rather than passive investing. So, in conclusion, it's clear to see that index investing is a reliable, low-cost alternative to actively managed investments. With their broad diversification and the simplicity of owning only one asset, you can benefit from paying less in transaction costs and capital gains tax. All this does come at the cost of eliminating the possibility of outperformance. Investing in the index will mean you match the returns of the index. If you want a more hands-on approach to investing and you have the time and knowledge to research individual assets, then indexing may not be for you. It's more about investing to suit your characteristics. That's all for the basics of index investing. Please like, comment and subscribe if you've not done so already. It is much appreciated here on this channel. Thanks for watching.